visit the bank for different reasons. Some people visit the bank to get loans to buy their first homes, others to pay off study loans or to buy their first car. Whatever the reason might be, we will all find ourselves in a bank at one point or another in our lives. This phenomenon is called consumer credit. Consumer credit, simply put, is credit advanced to consumers for the purchase of goods and services. It can subdivide into open accounts, personal loans at banks, credit card facilities, installment sales transactions, and lease transactions. It is important to note that a clothing or shoe account is also consumer credit. Now, let's look at what brings Wade and Nolwandle to the bank today.
Hey Wade, what a coincidence running into you here. What brings you here today?
I came to inquire about a loan that I had applied for that was turned down because I was told that I've been blacklisted.
What do you mean by blacklisted?
Do you recall the time when I was in hospital and I had broken my leg?
Yes, I do.
Well, because I couldn't work for 6 months, I had to use my credit card to pay for my monthly expenses. And when my credit card was overdrawn, I applied for a personal loan to help pay for all my other expenses. I couldn't pay back the monthly installments on my credit card and personal loan.
That's bad.
Many people find themselves stuck in the debt trap, just like Wade. They are led into a cycle of reborrowing or rolling over their loan payments because they are unable to afford the scheduled payments on the principal of a loan. These traps are usually caused by high interest rates and short-term loans. Anytime a person borrows money, there are two basic elements to the loan agreement. First, there is the loan principal, the amount of money that the person has borrowed. Second, there is the interest, the amount of money that the lender charges on the principal. Paying back borrowed money means paying back both the principal and the interest. Paying back the principal is especially important because it's the only way that a borrower makes progress towards paying off the loan in full. Many installment loans are designed to be paid off in a series of regular fixed payments. Each payment applies toward both the principal and the interest. A debt trap occurs when a borrower is unable to make payments on the loan principal. They can hardly afford to make payments on the interest, because making payments on the interest does not lead to a reduction in the principal. The borrower never gets any closer to paying off the loan itself. It's pretty similar to a hamster on a wheel, running and running, but staying in the same place. Harsh, but real. The amount of interest charged on a loan will vary depending on several factors, including the creditworthiness of the borrower, the type of loan being issued, and the general health of the economy. The borrower's creditworthiness is a very important factor, as people with good credit score can usually qualify for better loans at lower interest rates. People with bad credit, on the other hand, will be often saddled with higher rates and less favorable terms on the few loans they are able to get. Therefore, people with poor credit are generally at a very high risk for debt traps.
This means that Wade's inability to pay his credit card debt affected his credit score negatively, which then resulted in getting higher interest rates on his personal loan. The failure to pay both credit card and personal loan resulted in the bank's refusal to give him another loan.
Correct, Nolwandle. Some graduates also find themselves stuck in this debt trap. This is a result of study loans whereby a student and a parent with an income apply for a loan for the student. The parent is required to pay the interest portion of the loan on a month-to-month basis while the student is studying. The capital amount sits in the student's name, and the student is required to repay the loan through monthly installments upon graduating. After graduation, they are given anything between 3 to 6 months to start with repayments. Some students then take up more loans to help pay their study loans and end up in a cycle of debt.
Starting off your life with debt is never easy. I was lucky as my parents started saving up for my education from the time I was born.
It's always a good idea to start saving early.
Wade and Ray, please excuse me. I need to see a bank consultant as I want to inquire regarding vehicle financing. As discussed over the phone, I would like to get more clarity on vehicle finance and financing a home.
Vehicle financing involves buying a car through a bank. You get to buy the car and drive it while making monthly installments to the bank for a period of up to 72 months. These payments have interest included, and vehicle finance can be applied for with or without a deposit. Another option available is through a lease agreement, which gives you the right to use the vehicle as your own without owning it. Ownership rests with the credit provider, and you only have temporary possession of the car. Payment for the possession and use of the car is made on an agreed or determined periodic basis during the life of the agreement. Interest fees and charges are payable to the credit provider in respect of the agreement.
Thanks for explaining vehicle financing to me. Can you also explain to me how a mortgage loan works when buying a property, please?
When buying a first home, it is important to know already which property you are buying and what the cost of the property is before you apply for a home loan. The bank can finance 80 to 100% of your loan, and in return, you can pay back the loan in monthly installments for a period of up to 20 years with interest. Paying extra money into your bond every month or making lump sum payments means you pay less interest and can settle your home loan sooner.
Buying a home or car through financing requires you to know which car or home you are going to purchase. You need to be aware of the interest rates that apply on your loan. This requires an expert to help you choose the best method of purchasing and how to pay off your debt with the lowest interest possible.